All right. Thank you so much, everyone, for joining us today. My name is Tricia Hamilton, and I'm the chair of the OPWA Education Committee. So just a little bit about OPWA. We are a not-for-profit organization of professional public works practitioners. Our organization is the Ontario chapter of the Canadian Public Works Association and the American Public Works Association. We have approximately 600 members who are public work practitioners. We'd encourage everyone to take a look at our website to learn more about the work that we do and how to become a member and join us. We have a lot of opportunities, including for volunteering on many of our different committees. In terms of upcoming events, we have two more of these monthly webinars coming up. On October 25th, MTE Consultants will speak on deep infrastructure, which is how, with a lot of infrastructure already built, new infrastructure continues to go deeper and deeper, and how that challenge can be assisted. And then on November 29th, we have another webinar coming up on road widening, a project case study from RV Anderson. So for the webinar today, just a couple of notes. This is a Zoom webinar platform, so everyone's microphone and cameras will remain off. If you have any questions, we encourage you to add it to the Q&A box or the chat box, which you'll see at your screen. So at the end of the session today, we'll go through the questions with Matt and Peter. And yeah, so the duration is 1 hour, so we'll see how we're doing. If there's questions that continue a bit past 1 o'clock, we may go a bit beyond that. And of course, everyone has the option of logging out at 1. So with that, I'd like to introduce our presenters today. So Matt Manal is the manager of the surety department at FCA Insurance. With a background in underwriting at a large national surety company, Matt supports contractors across Canada in negotiating and maintaining their surety program. And Peter Toole, who is the VP of FCA Construction's insurance team with over 16 years of underwriting, brokerage, and leadership experience. Peter's experience in construction insurance includes assisting owners, general contractors, subtrades, architects, and engineers, and construction projects of virtually every type and delivery method. And with that, I'll turn it over to Matt.
Thank
Matt, are you able to share your screen there?
Yeah, I'm just going to pop up the presentation here.
Perfect. Looks great.
Is that okay? Okay, perfect.
Yep.
Thanks, everyone. I really appreciate everybody's time today. I know sitting through your lunch and listening to a couple guys talk about insurance and bonding probably wasn't on the top of everybody's priority list, but for those that it was, we really appreciate it, and thanks for joining. This is my first time presenting to this group, and I'm really excited for it because typically on our end of the business, we're working directly with contractors, occasionally getting involved in discussions with project owners and things like that. But it's really nice where sometimes we can collectively get together and talk about these topics where we are two parties that typically wouldn't on a day-to-day basis do so. So I encourage, if you have any questions throughout, please put them in the chat box, and at the end, we'll definitely get to those and have a discussion about them. As Tricia said, my name is Matt. I'm the manager of our surety department here at FCA Insurance. FCA Insurance is an insurance brokerage, so we represent contractors and clients to insurance companies all across Canada. We're mainly focused in Ontario. It's our only office, but we do have a presence nationwide. I'm also joined by Peter Toole. Peter Toole is the vice president of our construction insurance department. So we tag team a lot of these presentations and work with clients as a team. I handle the bonding side of things, and Pete steps in to handle the risk management on the insurance side. A little bit about FCA. We've been around for a really long time, and if you came to our office as things stand, you would see such. We've been around since 1919, so over 100 years now. And really over the years, we've evolved from, general insurance, taking on personal lines as well. And, in recent years, a really strong focus has been put on the construction space. And so both Pete and I were brought onto the team as part of that push and initiative to really make ourselves leader in the construction insurance space. This slide is sort of redundant because it's exactly what I just said. So I'm going to spare everybody the minute of looking at it. So maybe just the best place to start here is, what is the actual difference between insurance and surety? I'm going to speak to the bonding side of things first, and then let Pete jump in and talk about construction insurance. But a lot of people are sort of not understanding the difference between what is insurance, whether it's general or project specific, and what is a surety product, and why does the differentiation even matter? Both are sold by insurance companies, and that's basically where the commonalities die. Insurance, everybody for the most part understands. So I'll start with that. Insurance is a two-party agreement. So you have an insured person or party who has an asset or something that they're looking to protect. Sometimes it's just their balance sheet that they're looking to protect. Sometimes it's an actual physical asset that they're looking to protect. But in any sense, they're buying a product that is to protect themselves, and the insurance company is providing them a price that they bring in actuaries and they run different loss data, and using math they can determine pricing that makes sense so that they all collectively come together, and the premiums of all sort of subsidize the losses of a few. And this is done through an insurance contract. So it's a promise from an insurance company to indemnify an insured in the event of a claim, meaning that they'll pay them in the event of a claim for an insured peril. Where this is a little bit different from surety is that surety is much more similar to products that a bank would typically sell. It's a credit product. It's a three-party agreement, meaning that it's a promise from one party to uphold the obligations of another. And so in the most traditional sense, most people would have had a surety arrangement with their parents at some point in life, where maybe their parents had to co-sign on a mortgage for them when they got their first mortgage. Maybe they co-signed on their first, car loan. Whatever it is, it's somebody guaranteeing something on somebody else's behalf. And in the construction sense, where we see this is a construction company is entering into a contract, and under that contract, they have a number of obligations. But, the main underlying obligation is that they need to perform the work that they've said they're going to perform. And so a surety company steps in and says, we will guarantee that on their behalf. And where the big distinction lies in insurance versus surety is that surety companies are coming in and underwriting this with the assumption of zero loss. And so insurance companies, when they write insurance contracts, expect losses and price for them. A surety company is coming in almost like a lender would and saying, we expect not that you'll pay us back the money that we've lent you, but in this case, we expect that you'll uphold your obligation. And if we don't think you're going to uphold your obligation, then we're not going to issue a bond, which is the product that a surety company would sell. Now, all of this sort of probably has come to your mind. Now, a lot of municipalities and a lot of private owners and, whether it's provincial or federal owners, all of these owners have had bonding in the past, but the use of which has been very scattered. Some people were using them, some people weren't. The product itself was not uniform. So some project owners were asking for project or bond type A and bond type B and bond type C, and there were all these different bond types being used. And so when the Construction Act was revised, there was a new section brought in, section 85, that really referenced mandatory bonding and what that meant for public owners. So any public contract in excess of $500,000, it was mandatory now that bonds were provided in the amount of 50% of the contract value. And the bonds that are required to be provided are two forms that were actually legislated in Ontario, and that was the labor and material payment bond and the performance bond. And we'll get into what those mean later, but those are the two bonds that on any project over $500,000 in Ontario that's publicly funded, you're going to have to see those provided by the general contractor. And this was really to follow something that's taken place for a number of years at the federal level in the US, where something called the Miller Act was put in place to protect public tax dollars. And really, that's the essence of what we're doing here. I think sometimes that gets lost as to why we're even asking for bonds, but it's really in the public space, it's to protect taxpayer dollars that are going into build all of this infrastructure and improve, our cities and communities that we live in. And where, if a contractor says that they're going to build something or improve something for a certain value, they're held to that standard and they're held to that schedule that they've agreed to, for the most part. Now, the surety's role in all of this, in protecting public interest, really comes down to the essence of what we're doing when we're underwriting a surety product. And so, I wanted to just briefly talk about, you won't see this as a public owner, but maybe some of our consultants on the call, or if we have contractors on the call, you'll have had these discussions before where the surety is looking at three main things. And as a public owner, it's probably good to know, when you're being submitted a bond by a bonded contractor, what they've actually been vetted for. So the broker role in this would probably be fairly heavily weighted towards the character side, more so than the actually underwriting company doing it, because the broker role is to meet the contractors directly. And so character is a huge piece of this, because obviously if you're promising to uphold the obligations of another party, you want to make sure this party is actually trustworthy and actually somebody that you can work with in the future. So there's an assessment of character there, as well as capacity. And so this is where we're starting to get into maybe some of the more tangible parts of the job, where capacity is a measure of the work that they've completed in the past, the team that they've built together, and whether there's been an assessment that that team and the experience that they have are capable of doing the work. And so, where I've seen this in the past is, there's a notable case that I was a part of where we had a security company who was then bidding a number of public infrastructure projects, and it wasn't the same work that they were doing previously. And so there was a question of, well, has the team been put in place in order to actually bid on roadworks or sewer and water main work, or different types of scopes where previously they were placing staff at maybe municipal buildings or hospitals or TTC stations, whatever it was, to manage a security role. It was access point security. So that's where, that's our role, and that's the role of the underwriters as well, to step in and say, does this make sense that they've actually done this work before? And the last part is capital, which is really the financial health of the company. And this is where I spend majority of my time, is assessing the balance sheet, income statement, the financial health of a business, to understand whether from a cash flow perspective, they're able to actually take on any jobs that they're bidding in concert with all the other work that they have on the go. So what we're going to do is I'm going to briefly take you through the construction cycle a little bit, and just speak to the types of bonding that you're going to see throughout that cycle. I'm going to go through this fairly quickly because I feel like a lot of people are going to already sort of have been familiar with these topics. But like I said, if there's anything that pops up, put it in the chat and we'll talk about it at the end. So through the construction bonding cycle, I sort of break it up for surety purposes into three phases. You've got your pre-qualification and tendering phase, your construction phase, which is when the work is actually being done. And then after substantial completion is reached, we've got our warranty period, where the project has wound down, but any deficiencies are being managed. At the pre-qualification and tendering phase, there's really three documents that a project owner may be asking for. And they come with various degrees of commitment. And so sort of your lowest level of commitment and easiest thing to get for a contractor from their surety company is a pre-qualification letter. We see these asked for a lot when we're looking to set up pre-qualified bid lists, or there's a vendor list that people are trying to get on, where there might not be a specific scope of work that's being tendered at that very moment, but there's some sort of pre-qualification system that's in place to get a qualified list of bidders. And all this letter says is, yes, we work with them, and yes, we have confidence in them, and we could give them bonds if they needed it. Really, this is sort of your lowest level. There's no commitment. It's really just confirmation that, yeah, we've got something in place. We're not going to scramble at the last minute to secure bonding when you actually need it. Bid bonds are the most commonly used form of bid security, at least from what I've seen for public projects in Ontario. They're usually asked for in the amount of 10% of the tender price. And what they are is an instrument where if a contractor is awarded a contract, after a public bid, and they try to remove their bid at that stage, whether it's because they've overextended themselves and they have too much work, they realize they made a mistake in their tender value, whatever the reason is for pulling out, there's a penalty associated with that. And as a result, whoever the project owner is going to incur a financial penalty, because they're going to have to go to the second bidder who, under our public bid sort of system, is going to be higher. So the cost delta between the lowest bidder and the next bidder is covered. And that's where the surety is going to step in and say, no, you put in a bid, contract A was established, you must enter into the contract now. And if you don't, we're going to make sure that the difference is covered. So it's to protect the bid system and to protect people from just throwing silly prices at things and then deciding after the fact whether they want it or not. The next portion of that is an agreement to bond is typically issued in concert with that at the tender stage. An agreement to bond says, not only are we saying that our contractor is going to enter into the contract that they've been awarded, but we're also going to provide the performance and payment bonds that are legislated at that stage. And so this document, I'm not sure I would say it has as much teeth. Obviously, there's no financial penalty stipulated on the face of the agreement to bond. It hasn't been tested in court, mostly because it hasn't had to be. For the most part, the surety industry doesn't issue these documents if they don't have any intention of providing bonds once the contract's been awarded. So if you get a bid bond and an agreement to bond from a contractor, you can say with pretty safe certainty that they're ready to go for the actual award stage of the contract. So once the contract's been awarded, you're going to issue an award letter, and a contractor is going to be required to provide performance bonds and labor and material bonds under the Construction Act. And so I'm going to focus a little bit on these because these two are quite important. Performance bonds are the bonds that guarantee the actual work that's being completed. And so what I like to say is the performance bond comes out and says, hey, whatever the contract says, the person who has signed that contract is going to live up to it. And I guarantee that. And so everybody likes to ask, can I amend bond wordings and things like that? Unfortunately, the one part of having a legislated bond form that is not ideal is that because it's legislated, you can't amend it. And so any amendments that need to be made to the guarantee that the surety company is going to provide needs to be done at the level of the contract. So if the contract is going to address something like the duration of the warranty that the surety is on for, then that needs to be done, like I said, at the contract level. So the performance bond comes out and says, we guarantee that the contract is going to be lived up to. Now, the labor and material payment bond actually protects downstream risk in the construction pyramid. So the performance bond guarantees the upstream risk to the project owner and ultimately the taxpayer dollars. The labor material bond says, okay, well, what happens if our general contractor, for example, doesn't pay our subtrade? So we've got an electrical or a mechanical subtrade that is not paid by the general contractor. Well, that can cause a whole host of issues because then we're getting into situations where liens are being placed on projects, cash flow payments are stopping. All of a sudden we have to vacate liens. That can be quite an onerous process. And so how do we avoid that? Well, we put a labor and material payment bond in place that says, if you do not pay your subtrades, the subtrades can claim under the bond and the surety company will pay them out. And so that sort of takes away the pressure of having to lien, as well as it can handle things before it gets to the point where people need to lien. And frankly, we go back to the example of the first surety relationship. When somebody calls mom and dad and says, hey, so-and-so didn't make their payment to their subtrade, or so-and-so didn't make their first mortgage payment. When mom and dad come in or the surety company comes in and says, what's going on here? This is a valid claim. It needs to be paid. Money typically flows pretty quickly. So having a bit of, check and balance there can really help, even if it doesn't go to a claim. Now, lien bonds, I'm going to sort of skim over this because these are really only for situations where a lien has been placed on a project. The lien needs to be vacated in order to move forward with the project. And typically that's contractually the general contractor's role is to clear that lien. And so Lien bonds really are issued as security for the courts to hold to vacate the lien so that the project can continue. And then at the commencement or at the end of the project, they'll go through the legal process and determine who's in the right and who's in the wrong. So I'm sure a lot of people will be interested in sort of what is the claim process under a performance bond. So I'm just going to focus on the performance bond for now. If we have any sub trades on the call that have never claimed on a labor and material payment bond, they're having issues with receiving payment from a general contractor and they want to understand what that looks like, let me know. But I feel like majority of the people we're speaking to today are project owners, project managers, things like that. And so they're going to want to understand if a contractor is defaulted under their contract, what happens next. So because this is a public forum, I'm going to focus on the legislated form under the Construction Act. But frankly, most of them work the same way. It's really just a matter of the schedules may not be as clear. So in the instance where a general contractor has defaulted under their contract, the first step is an optional pre-notice meeting request. And I say optional because you don't have to do it. It's not a precursor to a written notice, but I really do recommend it. And in my opinion, a pre-notice meeting can actually get things back on track way more efficiently than you think they might. It is amazing what just getting people all in the same room at the same time with the surety company there, who typically has their own construction team. They bring in, maybe a lawyer or the underwriter. Everybody sort of realizes in that meeting typically that we're all on the same page. The surety just wants the job done because they don't want to claim. The contractor just wants the job done because if things are going poorly, frankly, they probably just want to finish the job and get off of it. And the public owner wants the job done because that's what they hired somebody to do. And so when you get everybody in a room and everybody realizes we all have the same goal here, it's amazing what can get done. Now, in the event, because we're all human and for some reason we can't get along, the pre-notice meeting doesn't go as planned and you still want to submit a claim, absolutely, that's your right. And so Schedule A, which is a document at the end of the bond form wording, is something called the written notice. And this is where you as the public owner make a written demand to the surety saying, hey, we'd like to put you on notice that we will be making a claim. Now, in the meantime, between the time you filed that written notice and 20 days later when you are required to have a response from the surety, obviously there's things that need to be done, whether it's for safety purposes. So there could be work that is sitting in a state that's not safe to leave like that. So you need to have work done. There might be work that you just need to continue because it's critical path and, it's going to delay the schedule to an unreasonable amount. I think of a school when we're sort of bearing down near the end of the summer to try and get work done at a school so that kids can get back. That would be an example of what I'm talking about. The bond wording actually provides, and this was something they added, which was really, really well thought out, for the actual provision of and discussion of interim work. And so when we have interim work that needs to be done, as a public owner, when you're doing this, please make sure you're documenting the heck out of it because those are costs that can be reimbursed under the bond. Next, after you've made your notice, we're going to head to the acknowledgement. So the surety is going to investigate, but before they investigate, they must acknowledge that you've provided them written notice within 4 business days. And then what they're going to do is they actually have to provide you a list of what they need. So it's not up to you to guess how much information do I need to send them. They're going to say to you, hey, this is what we need from you. Please send it in so that we can do our investigation. Over the course of the next 20 days, which is how much time they have to investigate, there may be a post-notice meeting again where the teams get together and they set a mitigation work plan in place. And this is really a formalization of the interim work that may have needed to be done in the first 4 days. So you'll meet with the surety, you guys will sit down and come up with a mitigation plan, and everybody will sort of sign off on, okay, this is what we're going to do until we decide what's going on with this claim. The surety will then come back after 20 days of notice, provide written response, either accepting or rejecting liability. there's actually 3 different responses you could get: accepting, denying, and then the third one is sort of this ambiguous, we don't know, we can't make a decision. So that one is in essence a rejection, but it's very rarely used. And, a lawyer that I spoke to when these bond forms first came out said, we really shouldn't be using this unless the public owner has woefully insufficiently given us information that we can't make a decision on. So if we've been given the information that we need, it really should be a clear acceptance or denial of liability. Once accepting, there's 4 available remedies, which are all written on the face of the bond. But really, I think you can break it down into sort of 2, if you're just being broad stroke with it. So the surety company, in essence, is either going to manage the construction moving forward, or they're going to pay out a financial penalty. And if they're managing the process going forward, they could take over the contract as general contractor. They could retender the contract. They could finance the current contractor to completion. But really, you're looking at 2 outcomes. They're either going to give you some money, or they're going to figure out a way to finish the project. Now, last slide for me. I just wanted to throw in a few different points that I think are sort of beneficial. So advice from your friendly neighborhood surety broker. One thing I always like to remind project owners is remember that you have contractual obligations as well. Because unfortunately, if you aren't living up to your end of the contract and you're in breach of contract as well, then it's really, really difficult to make a claim under the bond claiming that the contractor's in default when you are as well. So just remember, both your obligations under the contract and especially your obligations under law, and I specifically mean prompt payment laws. It's really important that you keep an eye on that. Ensure that you always have proper documentation, especially, like I said, with prompt payment laws, getting into things like adjudication, but also for surety investigations. We want to see what the latest approved schedule was. What are the most recent change orders that have been approved? What's been approved or what's been submitted but not approved? Keep a record of all of that. And I'm sure all of you do that very well, but you'd be surprised how many times I've seen it where people haven't. So just try your best to keep your documentation in order. And communicate with the surety as much as you need. I find a lot of times young people in the surety space will get freaked out when a public owner reaches out to them and says, we have a problem. And I always laugh and tell them, this is really good, because if we don't know about something, we can't help. And if we're brought into the loop and we are aware of a situation, we are representing our contractors, absolutely, and we're going to do our best job at representing them fairly. But we also are aware that things happen in construction where, there are times where our contractors are in default. And if we can find a way to get involved in that process, assist them with our resources, whether it's legal, accounting, project management, sometimes that's the push that everybody needs to get things over the finish line. And lastly, not all bond forms are equal. So for the most part, you're going to be using the Construction Act forms at all times. But if you ever notice or you end up in a different role, or, I saw a lot of engineers and consultants on the call as well. So you won't always be working with public owners, I assume. Check the forms because there's specific timelines that are involved with different forms for claims, for response times, for the schedules that you have to provide if you're filing a claim. So just keep an eye. There's some super common ones. CCDC is another common form that's used. But just keep an eye on those things when you're going through it. And with that, I think I've run a little bit over time. Sorry, Pete, but I'm going to throw it over to Peter now.
Hey, all good, Matt. Well, first of all, thanks everybody for joining Matt and I today to talk about surety and insurance. We were pretty thrilled to see about 200 people registered today that were that interested in surety and in insurance. I've heard it said before that insurance is kind of like a parachute. If it's not there when you need it, chances are you're kind of out of luck. So my goal today is to help everybody here understand the basics of insurance and help you parlay that into your contracts and into your processes so that you've got a well-packed parachute going forward. So Matt, if you can click onto the next slide there. So like I said, I want to kind of get into the basics of the insurance policies that are commonly asked for on projects. There's two types of policies that can be asked for. The first type is the contractor's corporate policy. So those are the policies you can think of as being like a contractor's shadow. They follow them everywhere to every single job. So that would be policies like the contractor's general liability policy. In a nutshell, that policy is there to protect both really the contractor, but also a project owner in the event that the contractor does something to either damage someone else's property or, God forbid, damage someone's person. So bodily injury, we would refer to that as in the insurance industry. The second one is automobile insurance. That's very commonly asked for. All contractors tend to have vehicles. It's essentially the same type of coverage that you would have for your personal vehicles, but contractors typically have a large fleet of vehicles, whether it be pickup trucks, it could be dump trucks, heavy vehicles, and occasionally, the legislation changed a few years back, a good 6 or 7 years ago now, that even contractors' equipment that is plated needs to be insured under an automobile policy. So I'm not sure if everyone's been familiar with that, but that's one of the nuances of automobile insurance and equipment insurance. And contractors' equipment insurance itself, that is the insurance that the contractor buys to protect themselves, their own assets against damage. So you've got a contractor coming to site, they've got an excavator or a dozer, front end loader, could be a pile driving machine. All of that stuff is typically worth a good amount of money. And so it's in the contractor's best interest to insure that stuff. But everyone on the call here, mostly being project owners, it's also in your interest to make sure that the contractor is insuring that stuff, because if it were lost or damaged and they didn't have insurance on that asset, it could be rather devastating for your project and the timelines. And finally, one of the most common corporate policies, or the shadows, as I refer to them as, is a contractor's pollution liability policy. This was a relatively new requirement under CCDC language, specifically under the CCDC2 lump sum contract. As of December of 2020, the CCDC2 contract, now as standard fare, requires a contractor to carry contractor's pollution liability insurance. And in a nutshell, what that is if a contractor creates some kind of pollution event. So that could be, spills, simple things like spills of gasoline or diesel, hydraulic fluids, or it could be that they've struck an underground storage tank that's been holding oil there for the past 20 or 30 years, and it spills onto other people's property. The key here is, again, damage to third parties. So that is the sites around you, your neighbors, and that sort of thing. So the next type of insurance that a contractor can bring to a project, to you as an owner, is project-specific insurance. And there's many different types of project-specific insurance that a contractor or an owner can buy. But I'll stick to the two most basic and frequently purchased types of policies today. And those are the builder's risk coverage and the wrap-up liability coverage. Most of you are probably familiar with these products, but I'll give a kind of a 35,000-foot view of what they are and what they do for you and for the contractor who buys them. So the builder's risk policy, that is specific to the asset that is being built or renovated, essentially. So it insures against physical damage to your project. It can also insure many different things, such as the equipment that's being shipped to the site. So it can insure those products or that material from the point of origin within Canada or the US, all the way to the site. And then it can insure those pieces of material or components while it's waiting installation at the site, or if it's stored offsite somewhere, because sometimes that's necessary too. And we've seen that more frequently over the last 3 years as the supply chain has been heavily damaged or weakened, right? So you see contractors that will procure materials well in advance so that they can have them for when they need them for a project, but they need to do something with them while they have them in their possession. And they're either store them at site or maybe at their own location or even somewhere else. So under a builder's risk policy, you can insure all of those circumstances, which, like I said, has been pretty vital over the last few years. And a lot of public owners, I would say, probably aren't overly familiar with the fact that a builder's risk policy can also ensure I call it future loss of revenues for a project. So for example, let's say you're a municipality and you have a contractor that's building a community center. And that community center is going to charge people, $5 to use the pool, and it's going to charge people $8 to use the tennis courts, and et cetera, et cetera. That's a source of revenue for the municipality. So what happens if there's damage to the project and it delays that revenue source? So for example, let's say there's a fire during the build of that community center, and it takes additional 6 months now to complete that project. Well, the municipality should have been earning revenues on that project for that 6-month period, but now you're not. You can insure that as part of a builder's risk policy, and I don't see that requested very often from municipalities or from different public owners, but it is available in the market, and it's worth considering when you do have a revenue generating project. Secondly is wrap-up liability insurance. This is very similar to the contractor's general liability insurance, except for a few very important differentiations. So one is that instead of just being for the contractor, it actually insures everybody on site. And that's why it's called a wrap-up liability policy, because it essentially wraps up everybody, all the project participants, under one policy. It also has limits of insurance that are entirely dedicated to the project, and it's one insurance company that's providing that coverage. So in the event of a claim, it's very clear who is going to be paying that. It's going to be the insurance company that's issuing the wrap-up liability policy. Back in the day, before wrap-up liability insurance existed, you would have the GC or the CM bringing their insurance to the project. You have the mechanical trade, the plumber, the electrician, the drywaller, the forming company, they all brought their own policies to site. And if an event happened, it was kind of like a murder mystery, who done it? And the insurance companies, they're not in the game of insurance just to simply pay out without asking questions. They like to investigate, and as they should, it's their money, right? And under those circumstances, before wrap-up liability existed, you had a lot of insurance companies playing kind of the blame game, the finger-pointing game. Well, it's not my client, or it's not entirely my client's fault. It was the mechanical trade, or it was the drywall trade that caused that issue. So without wrap-up liability, there's a risk that if there's a claim, it might not be clean, and it might not get paid out very quickly. So our guidance for, we call them more substantial projects, is to always at least consider buying a wrap-up liability policy, because it's a lot cleaner. It's got one single insurance company you're dealing with limits that are entirely just for your project. And what I mean by that is you don't have contractors that might have a claim at another job site that's totally unrelated to you that could reduce their limit of insurance. Without wrap-up liability insurance, that's a real risk that any kind of project owner takes. And you don't have insight into that because it's essentially impossible to track that for each and every contractor. So wrap-up liability, great product to consider. It's been around for the last 25 years or so. And it's very, very easy to obtain that product in the market. So project-specific insurance. The big question is, who buys it? Is it going to be the owner? Is it going to be the general contractor? And how is that decided? Well, the way the insurance industry describes the purchasing of these policies is either it's going to be an owner-controlled insurance program, or an OCIP for short, which means that the contract states the owner is going to buy the builder's risk, the wrap-up liability policies, or any other project-specific policies. That doesn't mean that the contractor or the contractors do not have to bring their own policies to the owner and to the job site. They still do. They still have to prove that they have all of the basics: general liability, automobile insurance, their equipment insurance, and possibly contractor's pollution insurance. They still need to bring all of that, but the owner is, in this situation, under an owner-controlled insurance program, is saying, we're going to take control of the project-specific policies, and we are going to design and we are going to buy and be generally responsible for the claims handling for the builder's risk and the wrap-up liability policies. The flip side of that is a contractor-controlled insurance program, or a CCIP for short. That's where the contract mandates and the owner has decided that the contractor will buy those policies, being the builder's risk or the wrap-up liability or any other project-specific policy. There's different reasons for decision-making in that process. Some owners might not procure construction all that often. And so they're not overly familiar with buying builder's risk and wrap-up liability insurance. And so they would prefer to pass that risk and that knowledge off to the contractor, who's probably doing that, once, twice, 3, 4, 5 times a month. Other situations may be where you have a project owner that has multiple projects ongoing at any one time, and they prefer to have more direct control of their risk management and the design of their insurance programs. And so they prefer to take on that risk in that process and buy the policies for themselves, which also benefit the contracting team. But this is just really a matter of control, who's controlling the policies. So as I mentioned, your tender, your contract's going to spell that out. And at the tender stage, the insurance will be spelled out to the contractors that are bidding your work, and they will then know what they need to bring to the job. Under a contractor-controlled insurance program, this is really important because for the contractor, because the contractor has to include the cost of those additional policies, the project-specific policies, in the amount of their bid. And that's why it's really important for the requirements, especially at the tender stage or the RFP or the RFQ stage, to be very clear. Who is buying the insurance? What type of insurances are we buying? What deductibles are allowed? Who is going to be handling claims or responsible for handling claims, settling claims in the event of a claim? We suggest to all owners to take at least a consideration of the CCDC 41 insurance requirements. Those are the basically standard policies that the CCDC insurance subcommittee has put together, and you can they're like an a la carte picking that you can choose from. And they're pretty well worded, they're pretty universally accepted, they're widely used across the country. And so that's why we suggest to at least take a peek at that. Because your contracting partners will be very familiar with that sort of language. You can change, just before I get on to that next slide there, you can change a base form contract. So if you're an owner who is using CCDC contracts, of course, you have the option to decide to change what that contract says, typically by supplementary conditions. So for example, under a CCDC 5B contract, that's a construction management at risk contract for the contractor, the standard form would say that the contractor is responsible for buying the project-specific policies. You can change that by supplementary condition, and so that you flip it to a OCIP, or an owner-controlled insurance program. I do caution anyone who would like to change that. Be very clear and concise with your supplementary conditions on how that's being achieved. If it's overly simplistic, I've seen something as simple as delete provision 11.1 and replace contractor with owner. And that seems really clear on the face value of it, but if you get into the details, and in contract law, the devil is in the details, overly simplistic supplementary condition like that could wreak havoc on the job at the time of a claim. So just be very mindful and careful if you choose to change a standard contract form, a CCDC form, by supplementary condition. Confer with your internal risk managers or your legal team or your insurance broker. They're there to help you through that. So just like Matt did for the bonding side of things, I want to go through what insurance is typically asked for and provided at different stages of a construction project. So during the pre-qualification or tendering process, some owners will ask for a full-blown certificate of insurance. And that will drive brokers crazy for the most part for a couple of reasons. Because if it's a bid and the contractor does not end up winning that bid, and most contractors of medium or large size are going to be submitting a lot of bids, and they're not going to win every one of them. So if they put out a certificate of insurance for each and every one of the tenders that they're going after, they're going to have a pile of certificates of insurance that they've put out to the universe through their policy term. And at the end of their policy term, they have to go through each and every one of those ones to decide which ones need to keep and renew and which ones to get rid of, the ones they don't need. So a better way of checking to see if the contractor has the necessary insurance policies that you require from your project is to ask for what is referred to as like a sunshine or a good company letter, which is essentially states the contractor has the following policies and or will have the project specific policies that are required by the contract. The signatories of those documents will always be the broker, and I'll get into that a little bit more in a future slide. So during the construction phase, that's when you as an owner, you need a proper certificate of insurance that's issued by the insurance brokerage and very clearly states all of the different coverages that the contractor is bringing to the project and the project team and you as the owner. When do you need that? That can be a topic that creates some tension. Sometimes owners may request it upon contract signing, and there might be a big gap between contract signing and when the work is actually commencing. And that can be problematic for project-specific policies because those policies don't kick in, generally speaking, until the job site is live, the mobilization has happened or happening. So if there is going to be a gap like that between contract signing and when the job starts, and there's project-specific policies that are being requested, that's just something to keep in mind. The contractor probably can't put those on the certificate just yet. And who and what, who's named, what policies are required. That again goes back to your contract, your tender documents, and what was told to the contractor that they need to bring to the table. And again, that's why those need to be really clear so that when it comes time for you to get your certificate of insurance, it's really easy for the contractor to come to their broker and say, here's my tender document. I've been awarded this work. I need a certificate of insurance. Can you get that to me today? If everything's there, typically we turn those around within about an hour. If it's missing a lot of information, there can be a lot of back and forth that happens where you're losing a lot of hours and time and creating frustration sometimes. And in the last phase, like Matt's warranty period, we don't have a warranty period per se in insurance, but for project completion, the new CCDC 2 contract would call it ready for takeover. To get final payment and to get certification that the job is complete, typically a contractor needs a live or an in-force certificate of insurance with all of the policies that are noted on there as still being in force. So make sure you have that. If you don't, go back to the contractor and ask them to update that, and they will speak with their broker to get that done for you. So I did want to give a quick example so you could see what some of these things look like. This is what we call a sunshine or a good company letter. And this is what you would receive or should receive during a bid phase or an RFQ, RFP, when the work is being tendered or negotiated and not yet awarded. So it'll have the name of the owner. Here we've got owner 123 Inc. at 123 Main Street. I got very creative with that, as you can see. It mentions the project number or maybe the RFP number, and it gives a quick little blurb about what that work is. In this example, it's renovation to Springfield School in Springfield, Ontario. And of course, it mentions who the broker's client is. In this case, it's, again, super creative by me here, ABC Contracting Limited, and goes on to state what insurance policies that we have in place for our contractor. And you can see there we list the general liability, auto, umbrella, pollution, and contractor's equipment. And we go on to say that if our contractor is successful, well, of course, we will issue a certificate of insurance, and we'll name the owner and any other parties that need to contractually be added to the policies as additional insureds, et cetera. So that's what a sunshine letter would look like, and that's what you would typically receive from a broker during the tendering phase. The next slide here is an example of a certificate of insurance. So this is where you have awarded the project, the contractor you've awarded the work to. In this case, you can see at the top left under insured is ABC Contracting Limited. They are showing you now that, yes, not only do we have these policies, but here's who the policies are issued through. You can see top right, it's got company A, B, and C. We've got Northbridge Insurance and Chubb as our insurance companies in this example. We also have more specifics. We have the policy number, you'll notice there in the middle of the page. We have the effective and expiry dates. And then, of course, the far right column will include all of the different limits of insurance for that contractor's policies. I did want to mention here that there's a lot of different things that can be asked for and required on a certificate of insurance. And sometimes it gets kind of messy to add all of that to a certificate of insurance. We always, as a broker, do our best to make that as clean as possible. But you can see we're working with kind of standard forms here that are across the industry, and they don't give us a lot of room oftentimes. So some things might be a little hard to find because the font is small. If you have issues with the certificate of insurance that let's say you have very specific requirements and you want to see all of that on the certificate of insurance, and it doesn't quite fit, or it's not displayed the way you'd like it to, you can always ask for a supplementary document, which is called a binder of insurance. And there will be a different binder issued for every single policy. And in that document, you can get as granular as you like, because there's unlimited space, because it's a custom form that's issued by the broker. So this is a certificate of insurance, an example of what one would look like, and this is what you would get at the award stage. I wanted to spend a little bit of time too talking about common sources of delays, questions that we get from our contractors, pain points, frustrations, whatever you want to call them. This is just a few examples. There's, like I said, many different types of insurance policies that a contractor can bring to the table. Under different types of work and different contracts, there's going to be a whole different litany of possible policies that you could see. But these are the most common questions that we see for public works. So what's in a name? What's an additional insured, and what's a named insured? And which do you want to be? An additional insured is someone who is added to the contractor's liability policy typically. So most commonly their general liability policy, saying that if that contractor does something that is covered by that policy, that insurance company will step in and will protect the owner, being an additional insured, for the actions of the contractor. That's what you want to be as a project owner. You want to be an additional insured, because you are being guaranteed that if something is covered by the liability policy or some other policies, the insurance company is going to step in and is going to defend both you and the contractor and pay any possible indemnity that might ultimately be paid under those policies. That's different from being a named insured. A named insured is the contractor. That's the person who buys the policies and has ultimate control over those policies. But it comes with a lot of responsibilities too, like paying the premiums, settling the claims. If a policy has to go to arbitration, it's up to the contractor, the named insured, to do that. You don't want to be a named insured on a contractor's policy on their corporate policies. Project-specific policies are a different matter. So if you have a builder's risk policy or a wrap-up liability policy, of course you want to be a named insured on those policies. And that's typically the way that the contract language is structured. It will say something along the lines of, property all risk or builder's risk insurance must be procured in the joint names of the owner, the contractor, the consultant, and all subtrades. That's different because that's a project that's specific to your site, your project. And the team kind of comes together in those situations to resolve issues that have to do with insurance. Requiring a certificate of insurance or a letter from signed by an insurance company. We see this a lot. Different municipalities will state very clearly in black and white that the document has to be issued and or signed by the insurer That creates delays, to be honest with you, because we as the broker then, who are the direct relationship and conduit of the contractor, are more or less cut out of the equation. We then have to go to the insurance company, who don't have the same sense of urgency that we typically would for these situations, and we put it into their court to sign. And sometimes it takes a day, 2 days, 3 days, 5 days. The preferred route would be to say the broker is the direct relationship with the contractor. The broker procures all of the policies and is essentially part of the risk management team of the contractor. So it should be the broker that's signing those documents, whether it be a letter during the pre-qualification phase or the tendering phase, or a certificate of insurance during the awarded phase, because that will both be a lot faster and will also create a lot less questions. Some brokers will sign those forms even when it says that an insurance company has to sign them. But I have seen instances where a contractor has been DQ'd, has been disqualified from a job they were awarded because the broker signed it and not the insurance company. And it's at that point, it's really semantics that have kind of gotten in the way. So I think it's just a matter of being really practical and saying that, yeah, the broker has the relationship with the contractor. They've put all these policies together. They interact with both the contractor and the insurance company on a daily basis. So it should be the broker that's signing those documents. Another one is not to do with insurance entirely. It's to do with indemnification agreements. The CCDC language that's on any one of their contracts, whether it be a lump sum, a construction management, a design build contract, it's considered, the indemnification language is considered fair and mutual. Any departure from that, where all or most of the risk is placed onto the contractor, will create issues for the contractor, because not all of those risks can be transferred to the insurance company. And even if they can be, it might require them to go buy more insurance than they otherwise would. So the advice here is, be as fair as you can when you do need to alter indemnification language because of the specifics of a project or a situation. Be fair, but be specific. Otherwise, it creates uncertainty, and uncertainty gets priced into a contractor's risk, and ultimately into the tenders and the bids that they submit to you. And the same is true of unclear insurance specifications. If the specifications aren't clear, and during the question period, the answers that come back are very brief and don't give much additional insight, the contractor is then going to have to price some of that risk that they see as being in the gray into their bid, essentially. And some common examples of that are where, let's say there's a wrap-up liability policy that's being procured for this project, but a project owner is asking for the contractor's general liability insurance to be the primary insurance and non-contributory. Well, that's an issue because the general liability policy in that situation is not primary. It's secondary, because there's a wrap-up liability policy that's there for the owner, for the GC, the consultants, and the sub-trades, that's designed to wrap everybody up under the one policy and be primary insurance for that project. So in that situation, if the insurance requirements asked for the contractor's general liability, their corporate general liability policy, their shadow, as I call it, to be primary, well, it can't be in that situation. So that creates some back and forth and questions that you could eliminate by having that knowledge. Builder's risk insurance. Occasionally, a project owner might not ask for either builder's risk insurance or installation floater coverage, but the contract's going to say that the contractor is responsible for any damage to that work, as it rightfully should. I mean, it's the contractor's work, it's their risk. But again, it comes down to being clear with the insurance provisions, because at the time of a claim, remember, insurance is like a parachute. And if it's not there when you need it, you're kind of out of luck, right? And that means usually the owner and the contractor. So for example, let's say that the insurance specifications did not ask for a builder's risk policy, but one ought to have been purchased. but the contractor who was bidding the work took the insurance requirements quite literally and just brought what they needed to the table, which did not include builder's risk insurance, and there was a claim. Well, what happens? It can get kind of ugly, to be honest. It will certainly be a negotiation investigation to try to figure out who's responsible, as it always is when an insurance claim happens. But ultimately, if there's no insurance there, it's going to be out of the contractor's balance sheet. So again, it's just a matter of clarity. And there is an inverse version of that, where sometimes owners might ask for a builder's risk policy for works that really don't require that type of coverage. Let's say, for example, really basic earthworks coverage, where it's just a site prep contract. Contractors coming in and doing some very basic low-level grading, not digging very deep, pushing earth around essentially, and hauling it off into dump trucks off-site. Sometimes we'll see that an owner has asked for builder's risk insurance, where a more appropriate coverage to cover that really small risk of physical damage to that earthworks would be an installation floater coverage, which is generally part of most contractors' corporate insurance policies. And it can have varying limits. It could be as low as $25,000, or it could be as high as a couple $1 million of coverage that contractor has. But again, that's something that we see fairly often. And you don't want to ask for stuff that you don't need, not just because it creates more questions back and forth and delays, but ultimately, if the contractor goes ahead and buys those policies, they're just going to build that into their price. So parting insurance tips for everybody on the call today. I think I've probably harped on this too much, but just being clear as possible in your contract language. And I think everyone has to keep in mind that every project is different. So work with your risk manager to create standard insurance requirements for different types of projects, but while also knowing that even within maybe those boxes you create of different types of work or sizes of jobs, that each one has its own specific insurance needs, that there could be some unique risks within each one of those categories that might necessitate further insurance coverage, or at least a discussion with the contractor about procuring additional policies. And last, just being practical. Accepting the COIs from us brokers, signed by us, that moves things along very quickly. And listen to the contractor concerns during the Q&A period. Be flexible where it makes sense for both parties. Like Matt said, we're here to look out for our contracting clients, but we realize we operate in a greater landscape of construction, which includes everyone here that's a project owner and even sub-trades. So we want to be as fair as possible to all parties, and we don't want to just push back on insurance terms or indemnification language just because we're kind of pushing for our contractor. We want to be practical too. And so, I would say just everyone where you can be flexible where it makes sense for both parties. And that's it for what Matt and I had to present today. So I think we could first of all say thank you for giving us an hour of your time for insurance and bonding today, and we can get into any questions that popped up in the chat while we were presenting.
Yeah, Keith, so I answered a few here in the chat. To anybody wondering, yes, we will be making it available. I think Trisha recorded the whole thing, and we'll be posting it somewhere. So I'm sure she'll let you know where it is. Looks like we've got 7 questions. Do you want me just to start running through them, Trisha, or how would you like to do it?
Whatever you think is best, Matt. It's a bit after 1, so we know we ran a little long, so people need to leave, of course. But we can stay a bit longer and answer a couple of these questions. So Matt, did you want me to read them, or would you like to?
You know what, I'm gonna poke through them pretty quickly because I think some of them are super easy to answer and overlap. So a couple questions I see about how do we determine the bond value, whether it's 50% or 100%. 50% is the mandatory legislated amount. That's not to say that if the risk management of your team decides that you want to, bond the project for 100% of the contract value, it's totally up to you. It's super common in the States, not as common in Canada. What I would say is typically something would have to go pretty catastrophically wrong for a total loss of 100% under the bond. And so, 50% I think was deemed by, the people who were doing the Construction Act revisions as sufficient, but like I said, totally up to you. Another person asked, how do surety companies cover their loss if a company does not complete their contract? And that's a really great question, and something that I meant to address on our differences between insurance and surety. Surety is a credit product. And so just like the bank, if the bank lends you money, you provide guarantees that you're going to pay them back. You do the same thing for a surety product. Typically it's the business, sometimes and frequently on the smaller to medium-sized business, it's the owners of the business as well. But in the event that there's a claim, they exercise their security through the form of an indemnity agreement, and they get their money back from the contractor. If they're insolvent, then sometimes it's tough luck and you don't get anything, but that's the nature of lending money or extending credit to people. Dylan asked a good question here. If the contractor who wins the bid starts the work but no contract has been signed, then pulls out, does the owner have recognition to pursue the bond? So the contractor starts work before they sign the contract. They haven't provided, I assume, a performance bond. And even if they did, there's no contract signed, so it's useless. So what I would say is, my advice would be don't have people starting work without a signed contract. Obviously, that's step number one. But if you find yourself in a situation where that's happened, you likely don't have a performance bond yet. And like I said, there's no contract. So the performance bond isn't tied to anything, even if it's issued. So all you've got left to rely on is your bid bond. The bid bond is going to follow the validity period or the bid validity. And so, if you're still within that 30, 60, 90 days, then yeah, perceivably you could claim on the bond, but you'd only be claiming on the bond for the difference between the first and second bid. Anything that's gone wrong related to the performance of the work would not be covered by the bid bond. And so, yeah, I would just say really make sure that that you're getting those contracts signed before work is commencing. Another question from Catherine was speaking about contract value increases, scheduling being pushed out. How does that affect bond cost? So the way bond costs typically work, and there's going to be different situations, but by and large, bond costs are charged on an annual basis. And so if you've got a project that's 12 months or shorter, it is charged based on the contract value and the contract duration. So any increase to the contract value will come at an additional cost to the contractor, and any delay in scheduling typically will come with an additional cost, unless, it was a 6-month project and it took 11 months. That shouldn't, result in any further cost. But I would like to just add the massive caveat that every company is going to work differently. So while I would say pretty much all the companies I work with charge on an annual basis for the contract value as it was, signed at the time of contract signing, there might be somebody who does it differently, but by and large, that's what you're looking at. So yes, if you're increasing the contract value, factor in the cost for the additional bonding.
On that same question on insurance, the project specific policies, let's say if the project itself increases in value or by duration, those are the two elements that are rated on for a builder's risk or a wrap-up policy. So if either of those two things change, they increase, it will increase the insurance costs. The builder's risk policy has a unique feature built into it for 99% of builder's risks that are placed out there, that if the contract increases in value by X percentage of value, that it's automatically picked up. Usually that's between 5 to 15%. So I think that was Catherine that asked that really good question. That's how the insurance would work for that, the project specific insurance.
I've got one more bonding question here, and then I'm going to toss it over to Pete because there's a couple more insurance questions. So, a really good question here about bond options in terms of wording. So, can you speak to the bonding options available for long-term, high capital construction projects where a single-term bond will not be possible? If a multi-term renewable bond is the only option, how can an owner reduce the risk should a surety company decide not to renew? This is a really tough question to answer. So I'm going to try to answer it to the best of my ability, but I want to just sort of set the table with any long-term project that is building something that isn't a service-based contract. For the most part, I think is done on, at least from what I do on a day-to-day basis, is done with a single term or, a construction act form, bond form. And especially if you're building in Ontario, that's the only option because it's legislated. So you shouldn't have to deal with an annually renewing form if you are, say, building some large piece of infrastructure that's going to take 3-4 years. It's going to be the legislated bond forms because it's an improvement, publicly funded, over $500,000. Now, if it's a private job, if maybe this was an engineer, a consultant that asked, the answer is it's really tough. So if the only answer you're getting back is that an annually renewing bond is all they'll issue, typically that's for service-based contracts. So security, janitorial, improvements via renovations to community housing, that sort of thing, where people are just on standby. If it's a massive project that's privately funded, so the Construction Act forms aren't used, the answer is sometimes that is just a risk you have to take. So you kind of have to decide, are you able to accept that? Or is there another form of security that you want to take in concert with the bonds that you're asking for? Or what you can do, and this is my favorite option, is get a bond with an upfront term of 3 years and two renewal periods after if it's a 5-year job. So you've got that guarantee for that massive portion of work at the beginning. And then, for the final 2 years, it renews annually, but usually most sureties are okay with a 3-year term up front. And then there was just one more. Do contractors ask for adjustment to bonds when change orders have been added to the contract and the contract value increases? Yes. So, the surety company isn't going to know if there's a change order. We only find out about it when we're asked about it. Some owners don't really tell us that often, or don't tell their contractors to go get the bonds amended. So, yeah, I mean, if I'm speaking honestly, if you don't find out about something, it's sort of hard to deal with it. So, a lot of the times this gets missed unless it's brought to our attention. So what I would say is if you want the bond value increased, you have to tell us. And yes, there's an additional cost for that, but that's just sort of, at least that ahead of time so that you can sort of plan for that.
On the insurance front, Nadal had a good question here. When should the builder's risk policy expire? At substantial performance or at the end of the warranty period? The builder's risk is designed to cover the project participants, including the owner, from the day the shovel goes into the ground at the beginning until usually 10 days after substantial performance, or what's now referred to as ready for takeover under the new CCDC2 contract. From the reason why there's this additional 10-day window that's provided from substantial performance or ready for takeover is because the owner will have to get insurance for the asset once the job is done. And it's not always exactly clear when you're going to achieve substantial performance. So the contract will say that the builder's risk policy has to be in place for 10 days after that, allowing the owner time to place their insurance for the asset going forward. It won't stay in place till the warranty period because once the job is done, the warranty kicks in and it's the owner's responsibility for insuring that asset. There was another question here of, and this is a tough one to answer, just like the one Matt just answered. Approximately what percentage of the project value does insurance cost come for a contractor who has good history of projects? Meaning, I assume to mean, not many insurance claims or no insurance claims. That's going to vary significantly on a couple of factors. One, the type of project. So, for example, if you're building a new structure out of wood frame, it's going to cost a lot more to insure that asset while it's being constructed than, let's say, like a community center that's built of non-combustible construction materials. The insurance companies price all of the different risks differently. A wood frame project, they unfortunately tend to burn to the ground once in a while. So there are greater project insurance costs that come with different types of projects, but also with different types of policies. So you might have a type of contract that requires something we haven't talked about today, which is errors and emissions insurance. And that product is for design build contracts for the most part. It's a very expensive product, especially over the last 2 to 3 years. And so if your insurance specifications call for that type of product because there's a design exposure there, it's going to cost you a lot more than it otherwise would to insure that project. So it really depends is the answer, and it can go anywhere from 0.5% of the project cost all the way up to 3, 4, or even more percent, depending on what type of project and what type of insurance products are required. So broad brush kind of answer there, but it's a pretty broad question too.
Awesome. I think that's all the questions, and we're losing people here. We're down to 70. So for the 50 of you that we paid to stay right till the very end, thank you. For the other 20, I don't know what you're doing.
All right, with that, then we'll wrap it up. Just want to thank Matt and Peter again from OPWA for being here. I think it was really educational and such a great overview, as we saw by the number of people signed on and the number of questions that we've received. So yeah, we'll thank everyone for sticking with us, and I guess we'll see you next week at our next webinar on the deep infrastructure. Thanks so much, everyone.
Thank you.
Thanks for having us, Tricia. Thank you, everybody.